Thanks for tuning in today. Today we're here with Jeff Sarti, CEO of Morton Wealth, a registered investment advisor with more than $2.8 billion in assets under management. Jeff's passion is to build diversified portfolios for his clients who want more than the simple 60-40 portfolio and are looking to build resilient portfolios with consistent cash flows. Jeff, thanks for joining us today.
Great to be here. Looking forward to it.
Awesome.
So let's start with, I was curious, you know, interesting facts here. You guys foster a lot of kittens. So you fostered over 100 kittens.
Amazing.
Talk to us about that. How'd you get into that?
You're starting with the interesting tidbit of my background. Yeah. Truthfully, this is my wife's passion. She's always been just an animal lover. Yeah. And then about 4 years ago, she said, "Hey, I just want to take care of kittens, little kittens. I want to bottle feed them." I'm like, "Huh?" And we just dove into it. My kids love it. And the first day, she brought home a litter of, it was 8 kittens.
Wow.
Literally they're a few days old. And you grow them until they're ready to go out and get adopted, 8 weeks. So we've done this probably north of 100 times, kept a few along the way, causes chaos in the house, which is fun. And then we've done some with puppies too, which is even more chaotic, but fun too.
That's really cool. Oh, that's amazing. Now, how many years? Has it just been kind of just a starting thing?
It's been about 3 or 4 years, and we go in phases. Sometimes you go in phases, and then all of a sudden you're like, "Man, we need a break." So I think we're in a break phase.
Did you have pets before that, or just this?
Yeah. We're both pet lovers. Okay. Yeah, mainly dogs and cats. Yeah. Some people are dog people, some people are cat people. I'm both. So wow. Yeah, so is my wife.
Usually you're in the one camp. I'm a dog lover. My wife's a dog lover, but then we have family members that are cat lovers too. Right. Yeah. That's pretty cool. That's amazing.
Yeah.
Awesome. Yeah. Very cool. It's I got one of our good friends, wife and I, they do the cats, and it's always fun when they get little baby kittens. Always the most fun to hang out with.
And they're so cute. These kittens too. Part of the reason I become a cat lover is, little kittens are so affectionate. They're not, loners like the adult kittens often become. Yeah. So they're just super cute, cuddly animals.
That's amazing. That's really cool.
100%. Awesome. Well, let's get into the meat of it, Jeff. Tell us a little bit about Morton Wealth.
Yeah, sure. So we're, as you mentioned, we're a wealth advisor. I've been around for a long time, over 40 years. I've been with the firm for about 20 years, and we manage wealth for about 1,000 clients or so. And our real differentiations on the investment side, and I'll talk to that, but just for some context of who we are, like most wealth advisors, we're typically the financial quarterback for our clients' lives. So, they have goals of, let's say, reaching retirement or some other goals. We help partner with them and set a roadmap for them. That starts with diversifying their portfolio, but then obviously it incorporates a lot of other strategies from cash flow planning, retirement planning, to tax, insurance, estate-related strategies, you name it. But again, our real differentiation, which I'm sure we'll talk about today, is really on the investment side, where we're quite different than your traditional registered investment advisor.
Very cool.
Could you give us some insights? What type of clients do you guys typically work with?
Yeah, our clients do come in all shapes and sizes, but I think it's more of a mindset that I would really refer to. And the term that I really think describes our clients well is they're healthy skeptics. And it's an interesting blend of optimism on the one side versus skepticism on the other. I'll start with the skeptical aspect. Our clients tend to be questioners. They're curious. They tend to question things. While we, of course, have stock-like investments, they tend to be somewhat skeptical of the stock market. They think it's potentially a little bit of a speculative game, a popularity contest, a lot like a casino in a lot of ways. And we would agree with much of that as well. They're also, question government policies, whether monetary policies, fiscal policies, you name it. They're concerned about the imbalances out there. But the flip side is, I would say, where they're healthy is they're optimists at heart. From a long-term point of view, they want to participate in the markets. They want to participate in the growth of the global economy. They know markets over time go up. So they don't want to just have their head in the sand and be doom and gloom and just, be in cash or treasury and gold only. They want to have a diversified portfolio. So they kind of straddle those two mindsets, from being skeptical and questioning on the one hand to wanting to participate on the other. And what we found is that we're sort of a unique voice or option for those clients, where there really aren't a lot of options to cater to that mindset, because most most status quo investors are very satisfied with, the traditional 60-40 stock bond portfolio. Kind of what's worked over the last 40 years, they believe will work going forward. Nothing wrong with that. But if that's your view of the world, I mean, listen, pretty much every traditional firm out there will cater to that and they'll do a good job. On the flip side, the doomsday type investors tend to be more do-it-yourselfers. Again, they'll be in cash, treasuries, maybe gold, commodities, maybe they're shorting the market. And that's fine too. But there's this huge world of in between those two states where, again, you could be resilient, protected on the downside, but not just be plain vanilla investing in stocks for the upside. There's so many different options for investors that those that have that mindset and want to build resilient portfolios, we provide an option for them.
Yeah, and Jed, with that in mind, what do you consider a resilient portfolio? Maybe from a diversification point of view, what is your view on diversification? Because maybe that will be telling as well. I'm curious.
Yeah, I think diversification is a great place to start, and we think diversification is wildly misunderstood in a lot of ways. So much of diversification, just going back to academics, was created in the 1950s back at University of Chicago, and great stuff back then, but it hasn't really evolved since then. And the mindset is, just mixing traditional assets, stocks, bonds, maybe commodities. And the problem with that type of diversification is you're really not diversifying across a variety of economic environments. So what I mean by that is typically with traditional assets is you're going to be exposed predominantly to two main things. Economic growth, or GDP, right? You don't want recessions for most traditional investments, obviously. And then inflation and or interest rates that are tied to that inflation. Typically, most traditional assets are challenged in inflationary or rising interest rate environments. So when we think about diversification, we think well beyond just stocks and bonds. And of course, any portfolio will have some stocks and bonds within it. But then what we're doing is we're looking for other asset classes that are just going to behave truly differently. That if the economy hits a speed bump, if inflation does stay volatile or even go up from here, that we can be in different asset classes that are going to do okay and march to the beat of their own drummer.
Yeah. And what are some of the other asset classes that you kind of talk to your clients about?
Yeah. So there really is a lot. From a high level, real estate, we do a lot of real estate, both on the debt side and the equity side. And we think real estate's a wonderful sort of hybrid between growth and income where you can have sort of your cake and eat it too. So we do love real estate, but listen, real estate is not a perfect solution because real estate is also somewhat sensitive to the economy and interest rates. So beyond real estate, we look for other asset classes in less correlated areas. And I'll give maybe a couple of quick examples. One is, for instance, on the healthcare side, we love healthcare as an asset class because when you think about healthcare and people need to take their drug or their medical procedure, even if they hit a rough patch in the economy, maybe lose their job, they're going to still keep taking their medication if they're fighting a critically necessary ailment. And so there's a lot of interesting ways to invest in healthcare, where if you're familiar with like royalty streams, like, Shark Tank as an example, where you can partner with biotech companies and you can, in essence, make a loan to that biotech company, but the collateral on that loan is, in essence, you own a royalty stream on that drug, on the sales of that drug. And so, as you can imagine, you're along for the ride, again, as that drug makes sales from one year to the next, but very uncorrelated. Yeah. Again, it's not that each individual investment won't have its unique risks associated with it, but when you think about the risks associated with an investment like that, again, if the economy goes up or down, interest rates go up or down, all you are exposed to is the sales stream of that underlying drug. So that's just kind of one simple example I like to give because I think people can really understand and relate to taking their medication for XYZ ailment and how something like that is much more resilient, immediately cash flowing. It's not like a J curve, like a typical private equity investment, and you're going to be uncorrelated with the broader economy.
Yeah. That's definitely like an interesting investment. It's definitely unique in the sense that it's. Talk to us about the correlation aspects. Kind of how do you, when you look for an investment like this, kind of how do you think about correlation and kind of what correlations do you look for?
Yeah, no, it's a good question. We spent a lot of time thinking about correlations, and even as a starting point, I think a lot of the science and everything we learn, like in college or CFA class, et cetera, I think it's very limited when it comes to correlations, because what correlation data looks at is all backward-looking data, whether markets are in an uptrend or a downtrend. And typically, when you think about when you need low correlations the most, it's in choppy markets or difficult markets. In other words, in up markets, which are, call it 70 or 80% of the time, who really cares about correlation data, right? I mean, when things are going up, most everything goes up and your portfolio is going to be fine. You don't really need diversification in those times. Yeah. It's really in down times. You think about 2022 when the market hit a rough patch, or really nasty environments like 2000 or 2001 or 2008, where in essence correlations go to 1. That's when correlations matter. So you can almost throw out like 90% of the data. Who cares if you have 20 stocks in your portfolio and they behave differently when the stock market's going up? Because that blended portfolio will kind of do fine no matter which basket of stocks you have. The important point is in the downturn, in a time like 2008, guess what happens? They all go down together and you do not have a diversified portfolio. So that's as a starting point. We think when people look at correlation data, they're looking at the wrong data. You really should think about what happens on the downside. The second thing that I'd mention is when we think about correlation, we're actually counterintuitively seeking out risk. So what I mean by that is when we're building a portfolio, it's not avoiding risk. To make money in any investment, you got to take on risk, right? That's just kind of investing 101. But what we're looking for is individual investments that have different risk factors associated with it. So again, as I mentioned, most investments have simply they want to grow. Growth of the economy is one of the risk factors. Interest rates is another risk factor. Inflation. So what we're looking for when we're looking for lack of or lower correlation are investments that will march to the beat of a different drummer and have different risk factors associated with it. So going back to that healthcare example, again, it's not that there's not risk in an individual investment like I mentioned, but as you can imagine, that risk is much removed or much different than just plain vanilla stock market risk, or is the Fed going to raise interest rates by 25 basis points or not? I mean, that just doesn't matter with an investment like that. So we're looking for things that are just, again, going to be exposed to different risk factors than what traditional investments are exposed to.
Yeah, that's really interesting. And you mentioned a couple of things earlier, Jeff. Obviously talking about the different risk drivers, right? Monetary policy, yep. Fiscal policies. How do you communicate that to your investors? I mean, obviously you're educating them about the process, what you guys think about, how you think about it a little bit differently. How's that process going to work out in real time? I'm just curious.
Yeah, we spent a lot of time educating our clients around some of these topics because, listen, these topics are very important when you're thinking about portfolio construction or risk in a portfolio. And most individuals are just not educated or armed with understanding these topics. We're not taught finance in school. We're not taught monetary policy or fiscal policy in school. And so many of our clients, very successful business owners, entrepreneurs, you name it, but they're really unarmed with a lot of the levers to pull on with regards to managing around some of these risks. Again, monetary and fiscal policy in particular. So we spend a lot of time educating, creating materials, webinars, seminars, et cetera, because we think these are themes that are widely misunderstood and really underreported on by our media. Like even going back to our recent, the presidential debates, back in November, very little, if anything, was talked about with regards to our debt levels, right? Or our fiscal policy, monetary policy. Yeah. Maybe a few little snippets here or there. And now we're starting to see some of this come to the forefront a little bit with, like the DOGE, the Doge policy of Elon Musk, et cetera. We'll see if they'll be able to have some success with that. But we think in so many ways from a long-term investing point of view, nothing is more important than long-term interest rate policy and fiscal health and or imbalances of our country. Yet the media at large just really wildly ignores this stuff. They really just care about short-term, what I believe noise, best performing or worst performing stock of the day, trends, inflation statistics from the last month or two, as opposed to longer term trends. So again, so much of our focus when we're thinking about building resilient portfolios is on these longer term trends that we educate our clients around.
Yeah, yeah, definitely. Obviously, having that conversation of long-term versus short-term, what your clients are looking at, invariably comes down to the question about liquidity too, right?
Yeah.
What makes sense. I'm curious what your thoughts are when it comes to liquidity in the marketplace.
Yeah, liquidity is a really, really interesting topic that we spend a lot of time talking about with our clients. And all things being equal, of course, you'd rather have a more liquid portfolio than not. Like if you had two investments that were identical in all things other than one was less liquid than the other, you would, of course, pick the more liquid investment between the two. That being said, I think liquidity taken to an extreme can really be a crutch from a long-term discipline investment point of view. What I mean by that is we all know it's, kind of, again, investing 101, behavioral finance, fear and greed are very powerful emotions that drive investment decisions. And what we do, and all investors try to do, is arm themselves against those behavioral biases. But in the background, typically, most clients, most investors have a 100% liquid portfolio. Literally at a click of a button that you could buy, or more dangerously, literally sell your net worth at a click of a button, now even on your smartphone. That I find to be very dangerous, but also just a tremendous distraction. If you think about even just what the word investing means, the word investment is going to have some element of time, discipline, sacrifice associated with it, right? I mean, if you think about investing in your health, in your career, whatever it is, that you're going to spend time and discipline fostering that endeavor. Yet with investments itself, we have to, again, at a click of our button, we can speculate, we can buy and sell, we have price targets. That's just so counter to long-term investing principles that I think from a high level, liquidity actually does more damage than good with broad-based diversified portfolios. I think it gives investors a false sense of control, because what it does is it gives your emotions control at the exact wrong times. So this is so much of why we actually embrace illiquid investments. One, is a starting point, we do think you could generate alpha or excess return by bearing some illiquidity in your portfolio. But in many ways, more importantly, it forces you just to have a true long-term investing mindset. Because if you buy something, you think about your home or investing in your business, when you're doing that, you're not thinking about, what's that price target and when am I going to sell it?
Right.
You don't have that distraction every moment of the day. So same thing with our long-term investments. Again, I go back to that healthcare royalty example. When you go into an investment like that, you're not thinking about, I hope it pops and I sell it in the next month.
Right.
No, you're making a sound long-term investment decision, and your goal is to own it for years and generate cash flow and hopefully appreciation along the way for years to come.
Yeah, definitely. I appreciate the mindset shift, because I think in our industry, as we all know, there's a lot of noise and everybody pushes liquidity, right? Transparency,
Totally.
liquidity, everything daily, NAV, process. But to your point, on the flip side, there's opportunity in illiquidity. I think
There's so much opportunity, and clients, again, they don't need to be 100% liquid. For many clients, a large percent, you need an emergency fund, of course. You need to be opportunistic and be able to have some liquidity to trade in and out of positions, et cetera. But for your core positions, I mean, you could be fairly illiquid. And going back to your point, because I know you guys spend a lot of time just even on the structural and fund administration side of things. In now going to the illiquid side of things, there's been very much of a trend, as you guys know, towards enhanced liquidity for what I believe should be otherwise illiquid investments. Private equity is a great example, right? Where typically private equity, let's say you go into a private equity fund, you're locked up for 10 years. Yeah. Now there's a real proliferation of interval funds or other funds with, call it, quarterly liquidity associated with those private equity vehicles. And I think that's potentially dangerous. I'm not saying that there aren't ways to protect against that and there's a perfect structure for every investment, but I think generating or creating structures where there's an asset liability mismatch to that degree, where you're in a private equity investment, but you, as an investor, you think you have the certainty of quarterly liquidity going in and out of that investment. Yes, in most environments, you're probably okay, but you should really be prepared as an investor if things go off the rails for whatever reason, your liquidity that you think you have might not be there in the time of need. So I think the industry's moved a little bit too far in that direction of overpromising liquidity with assets that should otherwise be more illiquid than liquid.
There's a balance, right?
Yep, totally.
Yeah.
Yep.
Yeah. And it's a huge mindset thing, like you brought up too. And I think that could kind of move us into some of this mindset stuff. But just the idea for like investors where it's there, like you can't touch it, you can't see it. You know, you get your statement every quarter, every year, whatever it is. It's comforting for some people.
Yes.
On that, why don't you talk to us about some like what are some of kind of like the typical mindset flaws that you see for, folks that come to you?
Yeah, this is an area I'm really passionate about, just understanding how all of our collectives' minds work as investors and our behavioral biases. I'd say one big one is around how investors typically react to and protect against uncertainty. Uncertainty is obviously it's ever present, right? And all things being equal, you want to protect against uncertain environments. And typically how our industry does that is it's through a sense of control through forecasting and predictions. I mean, I'm just looking right now, we're here at the end of the year when we're recording this, and I'm seeing right now so many 2025 predictions come across my desk. And a frustration of mine is that our industry really promotes this sense of how we add value is as experts who can have a crystal ball and can out forecast or out predict the average investor. The reality is, and studies time and time again and shown this, I mean, even the best of the best, it's not much better than a coin flip. Forecasting is a very, very challenging and difficult endeavor. Yet our industry really promotes this because the end investor, they get comfort in knowing that if they hand their money over to someone who has that crystal ball, if you will, there's a sense of control that uncertainty isn't so unsettling, that there is maybe actually some certainty to what the future holds that you as investor, Joe Schmo might not otherwise have. And I think that gives investors, again, a real false sense of confidence in a world that's inherently uncertain. So what we do as a firm, instead of spending all of our time on forecasting and trying to figure out the exact next trend in the market or interest rates or inflationary data, you name it, instead what we do is we spend our time looking for uncorrelated investments. We lean into the uncertainty. Instead of trying to outsmart the uncertainty, we lean into it, acknowledge that the world is uncertain. And as a result, we look for investments that will behave differently no matter what economic scenario unfolds. One analogy I've used in the past is the investment world is a lot like the ocean, right? The waves are volatile, they're unpredictable by their very nature. And I think the way most investors try to outsmart that volatile or uncertain environment is they try to, again, hone their skills about predicting the market. It's like surfing. They try to hone their surfing skills, right? They'll try to hone the perfect way to time a wave, getting on or off the wave. It's like buying or selling a stock at the right time. Oh, or let's say the waves get too big. What do? They pick up their board and they go to shore. That's like going to cash or going into bonds, right? It's sort of an all or nothing, perfect timing or not timing type of scenario. Instead, what is our approach? We take the surfboard and we put it off to the side. That's for fun and speculation. That's not for long-term investing. And instead, what do? Is we build a bigger boat. We try to build a big boat with a reinforced hull and ideally sides of the ship that are bigger than the waves itself, so that no matter what the size or outcome of those waves, we're just going to be in the water. That's the key, right? Staying in the water, compounding returns. We all know that. I think, was it Einstein, like the greatest still wonder of the world, one of the 8th greatest wonder of the world is compounding interest or something along those lines.
Right.
But it's the ability to stay in the water, stay invested, and compound returns over time. And so again, so much of our focus is not to outsmart the waves, but to stay in the water and build a resilient portfolio where you're just going to continue to compound over time.
Yeah, it's very important. appreciate you bringing that up, because obviously just having the mindset, talking to your investors, making sure they don't, there's not the panic, the emotional intelligence for if we're doing this to stay into the game. You have a plan, you're mitigating risk here. But when any little bumps in the road happen, it's not, let's drop everything. No, we have a plan. We're moving forward, rowing the boat in the direction we've already discussed, right?
Yeah, and on the flip side, right now in this environment, it's more of even the opposite, right? Overconfidence,
Right.
hubris, people really willing to put their foot on the gas. And listen, that might work, but it works until it doesn't. And it's very concerning. We're looking at sentiment indicators and other things. Optimism in the market is, in some instances I'm seeing, as high as it's ever been, even higher than by some metrics on par with the 1999, 2000 .com bubble era. And so that creates dangerous investor behavior on the other realm as well.
Very interesting. You mentioned earlier, but you talked about different debt levels. Can you talk about that a bit, maybe on kind of just how that, maybe even kind of going forward, if you have the thoughts? Obviously, nobody has a crystal ball, but just your thoughts. And as you talk to investors, what would you kind of talk to them about the debt level where we're at? And that always comes up, right? So just curious.
Yeah. This is something we've been talking about for a number of years as an investment firm. And at the very least, it's nice to see this is finally being talked about in the media at large. Starting to capture the awareness of the regular investor. I think it's a little too late, in all honesty, but at least we're talking about it.
Right.
But just even for broad numbers, rewind back about 20-ish years ago, pre-global financial crisis, our U.S. federal debt levels were in the $6 to $7 trillion range. We're now pushing, I think we're across the 35 trillion mark, I think maybe 36 trillion. I mean, just these numbers, they're growing exponential. It's just the imbalances are really extreme and unsustainable from our point of view. And just those numbers, if you think about it, it took us over 200 years as a country to build $7 trillion of debt. Mm-hmm. And in 20 short years, we've quintupled it. I mean, these types of numbers are absolutely unsustainable. And when you think about these numbers, I mean, the word trillions being thrown around, they're numbers that we can't even really comprehend. I mean, they're so large. If you bring it down to the average taxpayer, what that means is the average taxpayer's share of federal debt is approaching $300,000 right now. So literally the average taxpayer to pay off her debt, it would have to write a check for, I think the number is $280,000 or $290,000. And by the way, that does not even include, in essence, the unfunded liabilities of Social Security and Medicare. That's off balance sheet. That doesn't really count. But that's, by any conservative measure, many times of the order of magnitude larger than that. So by the most conservative estimates, it's, call it 100-ish trillion, those types of numbers, which means the average individual taxpayer would have to pay, by my math, $800,000 or $900,000, up close to $1 million, just to pay off our debts.
Wow.
I mean, these types of numbers are just absolutely unsustainable from our point of view. We think their path of least resistance is potentially higher inflation going forward. We think the way to solve this is continued debasement, probably continued money printing as we continue to get in trouble, et cetera. And so it's building portfolios with that mindset, with an understanding that you have to protect against these risks because they're not just going away anytime soon.
Yeah, it's really interesting. I know, a lot of I know we talked a little bit about gold, and how you guys think about gold before this call. But yeah, why don't you tell us kind of your views on gold, and maybe we get into crypto a little bit too.
Yeah, no, be happy to. Yeah. Listen, probably even sharing your mindset. I know you guys and a lot of your audience are passionate in the crypto space. A lot of our passion around gold, and we've been investing in gold going back to 2015 for our clients, is around these concerns and these risks. I mean, we talk about the fiscal side with debt, but this on the monetary side, going back again since 2008, 0% interest rates. We're here for so long, money printing galore. We're in a world where it's not just the U.S., but pretty much any country around the world can print its own currency to fix its problems. The fiat currency is we think inherently inflationary and unstable, and over time, the value of our currencies it's baked into it are going to be devalued over time. And so gold has a 5,000-year history of of holding its value, of being truly an alternative currency that withstands the test of time, withstands different empires over time. Gold has always been there. And again, will be a store of value. We view it as an alternative currency to hedge against these, what we believe, inflationary or debasement risks. We think those are one and the same. We think inflation doesn't just mean higher prices. Inflation means the eroding value of your currency, namely the dollar. And so gold for us has been a modest size hedge in our portfolios, again, for quite some time to protect against that risk, because most investors, basically 100% of their assets are tied up in US dollars. And over time, that's just going to go down in value over time. So listen, from a high level, there's a lot of criticism of gold, probably even similar criticism to crypto and Bitcoin in particular. It's what is it, right? And gold is all I agree. All it is a pretty shining rock, right? It doesn't have a dividend. The beauty is in the eye of the beholder to some degree. But what gives us comfort is the holder of the value of gold. It's been proven over 5,000 years throughout society. It's, gold has had value. It's been volatile. There's times where it goes up and times where that go down. But if you have a long-term mindset, it's tended to at least keep up with inflation or debasement of currencies over the long run.
Yeah, for sure. And obviously, talking about crypto, as you mentioned, some people view that as digital gold. Some people view it as venture investment. Some are able to cash flow with DeFi and other things as far as that goes with yield. Just curious kind of what you're seeing with what you guys view with your clients from that perspective.
Yeah, so it's something, especially with our interest in gold, without a doubt, it's something that we followed for a number of years and are paying attention to. Part of the reason we haven't dipped our toe in the water as of yet is we do have a core gold position, and we do believe there's a world likely where both crypto and or Bitcoin and gold can coexist. Maybe there will be a winner way out in the future, but we think that's way out in the distant future. With regards to Bitcoin itself, again, we believe that a lot of the same thesis for why owning gold and why owning Bitcoin, there's a lot of consistency between the two. One of the main reasons that we haven't to date dipped our toe in the water with Bitcoin is it's just the short-term track record, in all honesty. It goes back to 2011. We feel it hasn't really been battle tested yet. Now, I'm sure some of your listeners are probably screaming at hearing this because I know they're passionate about being like, oh man, it's proven the test of time. And to some degree, I might even already too late, right? With Bitcoin now, right around the $100,000 mark. But to be just transparent, and again, one of the why I believe we're too early in the cycle to really make sound, fundamental, long-term investment decisions around it is I believe that the lion's share of Bitcoin investors, and these are not probably your listeners, but 90+% are just chasing a price, right? They're chasing something that's done tremendously well. And it's tracked more like NVIDIA or the NASDAQ more than anything else in terms of its correlation generally. And so they're tracking a price as opposed to I'm picking a number out of thin air, the 10% of investors who really believe in the fundamentals for the long term. And what I struggle to figure out is how much of the price of Bitcoin and other crypto is driven by that 90% versus the 10%. So even as a simple example, like Dogecoin now, or what is it, Fartcoin? I feel like I got to get bleeped out right now. That right, Fartcoin has been the best performing crypto in the last month or two. I think it's over $1 billion now of value. I mean, there's so many of these that are just utterly absurd that obviously a lot of these, not all of them, but a lot of them will go to zero and over time. And while there's so much speculation as evidenced by these prices in these coins that are ultimately going to be worthless, it is hard for me personally to assess how much of Bitcoin's price is that versus the actual long-term sound fundamentals that potentially should be driving Bitcoin's price higher. So I'm struggling to quantify that differentiation.
No, I think that's a fair point. I'm curious though your thoughts on the correlation between gold and digital assets, right? What are your thoughts there? between the two?
Yeah, listen, I'd be curious on even your guys' opinion on that, because you guys follow it more closely than me.
Yeah.
I think there's times, and especially with Bitcoin versus the others, where I've at least seen anecdotally where it does appear to move in line with precious metals and gold in relation to Fed movements, inflationary concerns, debt levels, et cetera. And that rings true to me. That makes sense. There are other times where, as I mentioned before, where I've seen in moments of euphoria where it feels like Bitcoin is moving up and down more in correlation with NVIDIA, which to me, that's not a healthy sign. That's just the market chasing price and too much speculative fervor in the market. And again, that goes back even to my comment on where we're too early. Like, I've seen it sort of all over the place to some degree, and I can't quite quantify which one it's tracked more closely to. Does it track more closely to precious metals, or does it track more closely to speculative assets? I think it's too early to tell, but I'd be curious on your guys' thoughts on that.
Yeah, Mike,
Yeah. I have some data here. I'm actually I'm just looking at I'm pulling up the terminal as you're speaking. But it looks like over the last 3 years, its correlation gold is 0.125. Over the last 30 days, its correlation is 0.49. So I would say it's relatively uncorrelated to gold. And looking at the S&P 500, it's been a pretty consistent about 0.4. So I would say it does over the last 3 years, it's 0.429. Over the last 30 days, it's 0.412. So it's,
Sure.
I would say it's more correlated to stocks than gold, but it's interesting to think about.
Yeah. Well, even too, the size of the asset class too, to your point, Jeff, I mean, that's where there's a lot of things that can move volatility, quickly in digital assets and crypto. It's obviously it's growing over time, right? It's a nascent asset class, but and things were correlated for a long time. Now they weren't. Now it flips and flops many different times over years, as we know. So yeah, who knows? We'll see. But it definitely is. It's not going away. I mean, I will say that for sure. To stay. Just where the question is, what it's going to look like in a few years from now, based on all factors out there.
I guess to turn the corner, Jeff. One thing I was thinking about, when it comes to like the 60-40 portfolio, I know you guys think about that a lot differently. How do you guys generally, think about, diversification and stuff for your clients? Like, are you guys thinking kind of more like, 30-30-30, or kind of what is your ideal, diversification?
Yeah, no, it's a good question. And the starting point is every client's going to be different. And I know that sounds somewhat like a cliche, but it really is true, right? Depending on age, illiquidity, ability to take on illiquidity from a cash flow point of view, earning power, you name it, risk tolerance. It really is. It's a wide range. That being said, if I look, just across our whole client base, our stocks, and I'm going to be off by a few percent here and there because I haven't looked in recent days or weeks, but we're probably in the 20-25% range in stocks. Which is very low. I don't compared to most traditional wealth managers. And then on the bond side, especially on the traditional sort of plain vanilla treasury corporate bond side, we're even lower than that. In daily liquid bonds, we're doing more structured finance stuff, asset-based lending, things of that nature, where we think we're more protected but can generate similar or higher yields than plain vanilla corporate bonds. Corporate bonds are expensive. Spreads are really tight right now. So basically what that means then, and again, it depends on the client and how much liquidity they can take on, but everything else can be upwards of half their portfolio or even more. Could be 60%, could be even more than that. And I'm including gold, and we do have some gold mining positions, some other kind of commodity, mainly through stocks, some commodity related positions. But then the lion's share is around illiquidity. Typically on the lend, we tend to be more exposed to lending focused strategies as opposed to equity. Part of that is just we want to be in a more resilient place in the capital structure. All things being equal, if we're senior secured in first position when we're lending to a corporation as opposed to equity, we'd rather be there. Secondly, especially since the regional banking crisis, there's really been a void in lending where we think we can make really attractive equity-like returns, but still be in a lending position. And then lastly, like I know I mentioned that royalty example earlier in the call, but our lion's share of lending, as you guys know, private credit has exploded, but the lion's share of private credit is just lending to corporate America based on companies' earnings and cash flows. We do some of that. And I don't want to say we don't do any of that, but by the large majority of our focus is lending to companies based on assets. So it could be anything from a trucking fleet that a company owns, or literally through a group we lend with. They lent on an agricultural company based on the fleet of its tractors, to inventory of all shapes and sizes, accounts receivable, you name it. Again, it goes down to this theme of resiliency. I want to be lending in situations where, yes, of course, I want the company we're lending to do well and to grow its earnings. But even if it doesn't, even in that, going back to that theme of uncertainty, even if something goes wrong with that company, or from a macro point of view, we hit a recession, we want to be able to grab those assets. And as long as we're at a good attachment point, i.e. low loan to value, we're going to be okay. So we're comfortable really having a large sizing to assets, loans like that, especially if they're diversified across product type, industry, et cetera. We think if you lend, again, at a low loan to value across a diversified sector of loans, you're going to be really resilient and generating cash flow along the way.
Yeah, makes sense. And a question regarding kind of how you deploy capital on behalf of your clients and investors, is that in a separately managed account format and fund format? What does that look like for you guys?
Generally, so a client, the client's assets will be in their name. We custody assets at Charles Schwab or Fidelity. Yep. So typically with the traditional liquid assets, we're going to invest in mutual funds, ETFs, et cetera. That'll be directly housed at Schwab or Fidelity. But then on the illiquid front, typically we're invested in private partnerships. They're limited partnerships across a variety of different asset classes. We're not the general partner. Typically, it's someone else that we're investing with. That's the general partner of that subset or strategy. It's experts in various fields. We're often, not always, but often one of the largest, if not the largest, collective investor with these funds. So we're often, we have a lot of buying power, negotiating power on fees. We're often on their advisory board. So we're very involved. One last thing I'll just quickly mention is we just actually did launch our own internal fund where we are technically the general partner. And the reason for that, it's around access for our accredited investors. A lot of our high conviction investments, especially on the private lending space, they're for qualified purchasers only. That's the $5 million net worth threshold and higher. So what we did is we last year created our own vehicle. In essence, it's a fund-to-fund vehicle where we're pulling together assets and making loans for our qualified purchasers. But what we did was we just registered it with the SEC. We finally got approval literally in the last few weeks, which is really exciting. So that now our lower net worth accredited investors can access things they otherwise couldn't in years past. So we're creating something that we feel wasn't out in the marketplace because we're so passionate about these asset classes, and our lower net worth clients were not able to access them to the degree that our higher net worth clients were able to access them. So that is the one vehicle that is technically our own. Outside of that, though, we allocate to other managers.
No, that's great. Congratulations. Obviously, I'm an access or a feeder to
exactly
capital to allow that for lower tier, more lower AUM investors. That makes a lot of sense.
Yep.
And that was actually one of the things I want to talk to you about too, Jeff. How you mentioned, when you're working with these investors, and a lot of times when you end up being the largest LP, you have say in kind of things like you mentioned, like fees, structure, things like that.
Yeah.
Talk to us a little bit about that aspect, because there are, obviously, like there's funds that we talk to, that maybe they are working with like one large investor, the seed investor, whatnot. Kind of talk to us about the LP side of things. How do you work with the GPs and kind of what are some of the things that you talk about when it comes to structuring these funds?
Yeah, we have a lot of experience to do this. I've done this for a number of years. And our chief investment officer, her name's Megan Pinchuk. She's just brilliant, really, really thoughtful in partnering with funds and helping them structure in appropriate ways. I'd say one of the main areas, and I alluded to this quickly earlier on this discussion, that I think we add a lot of value. It is on structuring funds from a liquidity point of view in a thoughtful and appropriate way that's fair for all parties, whether people coming into a fund, existing investors, or exiting investors. And so, like, what I mean by that is, especially on the lending side of things, there's a lot of evergreen funds out there. Typically, let's say they're quarterly, year lockup, initial lockup, and then quarterly liquidity thereafter. And we invest in a number of funds like that. And that's appropriate. Like, for instance, in the real estate lending space, where loans are very short term, 9 to 12 months, that's a totally appropriate profile because quarterly liquidity is reasonable. And again, in a real nightmare scenario, those funds can obviously gate, which is appropriate if the liquidity is not there in an unforeseen circumstance. But as you get a little bit out on the term perspective, meaning maturity of loans, let's say if you're lending on other assets, typically, let's say these are 2 or 3 year loans. I mentioned trucking fleets or tractors or inventory, et cetera. That quarterly liquidity is, again, in most environments, that's okay. But we think that's potentially a little too liquid for if an unforeseen circumstance happens, there's a run on the bank, et cetera. That's theoretically a little too liquid for a structure like that. So what we've helped funds structure with is a sort of a hybrid between a closed-end fund on the one hand and an evergreen fund on the other, where in essence, it's an evergreen fund, but it's a hybrid structure where when an investor wants liquidity, they raise their hand and then they enter into what's called like a roll-off structure where they're almost side-pocketed, but they own still, they could get the lion's share, let's say, of their money back as liquidity comes out of the fund in the first quarter or two. But then over maybe a year or two, they're in a side-pocketed vehicle where they own a pro rata piece of those remaining illiquid loans as they pay off. And so that's a way where you're not holding the fund hostage. You're not forcing gating, if you will. That investor is kind of in its own side pocket. And the rest of the fund can behave as if there's business as usual. So that we do a lot of kind of interesting hybrid structures with funds where, again, close in on the one hand may be too restrictive, but maybe evergreen with just quarterly liquidity at all times is too liquid. So that'd be kind of like one simple example.
Yeah, or I guess on the interval side of things, more of a certain amount of percentage tops per quarter that they'll even allow for liquidity, and then that wait right till another quarter or whatnot. I've seen that as well. I'm curious, just on even the economic terms in the fund, obviously being a larger LP coming in saying, hey, I want to negotiate fees, maybe the most nations clause, those things probably come up, right? I'm curious those conversations that you have with GP.
Oh yeah. I mean, we're having those types of conversations all the time. Yeah. And just, typically a lot of it is around, mainly around fees than anything else. We will, when we go into a fund and we feel like, let's say there's not the right provisions in place from, let's say, key man provisions or cash controls, third-party checks and balances, the truth is we're not going to ask for something that just special for us that another investor wouldn't get. If we ask for something and need for a fund to improve its operational structure for whatever reason, and if the fund for whatever reason is not able to do that, we just won't invest in the fund. But more often than not, I think we're really partners. We don't make funds' lives difficult. I think we're really thoughtful and we're really wonderful partners with the funds we work with. We help institutionalize them in a lot of ways and make them better. So I think they view us in that light and appreciate it. And so typically when we ask for some of these enhancements, I think it's welcome news on behalf of the underlying fund. And they embrace it because they know it's making them better from a long-term point of view as well.
Yeah, what's your point? I'm sure that the pitch, if you will, is you're also educating your clients, your investors too, from a different mindset perspective. So you're not going to have maybe the typical conversations they would have with other investors potentially, right? They're exactly out of these funds. Now you're having these conversations saying this is more of a long-term approach. Here's our process. Here's our thesis. This is how we're going to go about it, right?
Exactly. Yeah.
This has actually been a great conversation, Jeff. I'm just curious, based on kind of where you think of, I mean, obviously nobody has a crystal ball, but where is the market? What are you guys thinking about as we go into the new paradigm, new regulatory regime, 2025? What does it look like for you guys?
At the risk of stating the obvious, and listen, this is already priced in the market. It feels like not picking sides here, but with the Trump win, lower regulation, pro growth. that would not surprise me. But to some degree, potentially that's already priced in the market. Again, more from a long-term point of view as opposed to a short-term point of view, the market is not cheap. And even if we compare, let's say, market levels, I'm talking about just even simple PE ratios to like 2016, when Trump came in, both PE ratios are much higher than they were then. Our fiscal imbalances are much worse than they were then. Our inflationary numbers are much more fragile and vulnerable than they were then. So if investors just think that it's going to be a repeat from a market point of view, as it was from 2016 to 2020, I think that's short-sighted. I think the starting point is drastically different. Even comparisons like you could say even to the Reagan years and his pro-growth environment. If you look back to the early 80s, I mean, we were at a PE ratio of 7 or 8 versus a PE ratio now of the low to mid 20s, depending on what metric exactly you're looking at. Price matters. I think nothing matters more than price. You can have a good investment and like a company, but if it's trading at an expensive price, you should wait or play your cards a little bit closer to the vest.
That's great.
Yeah, I think that's great. That's yeah. I mean, I've even looked like it's been one of those things I've thought about recently where the market's been hot for a very long time.
Yeah.
And you see those drawbacks. Even going back to the early 2000s where it took 10, 15 years to get back to that all-time high. It's kind of wild to think about.
Yeah. I mean, listen, we really have no short-term crystal ball. The market could be up another 20. When you hit speculative stages, that can last longer than you otherwise think, right? So the market could be up another 20, 30% next year. I don't know. And so that's why we have some stock exposure. But again, we're going to be much more modest and limited because at these levels, this is just pure math. You're looking at history. At these levels, when you look at valuations, once they've reached these levels, and it's only been a few times in history that they've even come close to these levels, actually. The only time it was more expensive was 1999. But at previous market peaks of valuations like this, you typically have, going forward, mediocre stock returns, typically in the low single digits. And it's interesting. I think it was Goldman Sachs just came out with their 10-year forecast on stock returns. And I think the number they picked was like 3%. Vanguard, similar 3 or 4%. I mean, these are organizations that are incentivized to promote strong stock returns, but at a certain point, it's just math. When you're starting at expensive valuations, there's a lot of headwinds. Things have to go perfectly for you to generate, 10% stock returns when your starting PE is this high.
Yeah. Awesome. Well, Jeff, this has been a lot of fun chatting with you. Appreciate you sharing your insights. Where could people go to connect with you and learn more about Morton Wealth?
Yeah, easiest place is just our website, Morton with an M as in Mary, mortonwealth.com. You can find me on LinkedIn pretty easy as well. Jeff Sarti, Sarti. I'm on LinkedIn. Or my email is jsarti, JSARTI @mortonwealth.com.
Amazing. That's great, Jeff. Again, appreciate the time. I'll make sure to include all that in the show notes as well.
Cool.
Thanks so much, Jeff.